A'udhu billahi minash shaitani rajim. I seek the protection of Allah against the devil. Bismillahir Rahmanir Rahim. In the name of Allah, the most beneficent and the most merciful. Rabbi zidni ilma. O my Lord, increase in my knowledge. Rabbi shrah sadri wa yassir li amr wahlul uqdatum min lisani yafqahu qawli. O my Lord, open for me my chest, grant me the self-confidence, contentment and boldness, and make loose the knot from my tongue that they understand my speech. Assalamu alaikum. May peace, blessings and mercy of Allah be upon you and to all the messengers of Allah, and in particular on the noble and the final messenger Prophet Muhammad, peace be upon him, his family and his companions. In this video, we will be learning about the section C, Performance Management of the CMA Part 1, Financial Planning, Performance and Analytics. It has the weightage of 20% in exams. Formula of Variable Overhead Spending Variance. The variable overhead spending variance is equals to the actual variable overhead cost per unit of allocation base actually used minus with the standard variable overhead cost per unit of allocation base. The result is then multiplied by the actual quantity of variable overhead allocation base used for the actual output. Formula of variable overhead efficiency variance. Variable overhead efficiency variance is equals to the actual quantity of variable overhead allocation base used for actual output minus with the standard quantity of variable overhead allocation base allowed for actual output multiplied by the standard application rate. Types of fixed factory overhead variances. There are two types of the fixed factory overhead variances. A. Fixed overhead spending or the budget variance. B. Fixed overhead production or the volume variance. Formula of fixed overhead spending variance. Fixed overhead spending variance is equals to the actual fixed overhead incurred minus the budgeted fixed overhead. Formula of fixed overhead production variance. Fixed overhead production variance is equals to the budgeted fixed overhead minus the fixed overhead applied. Types of sales variances. There are two types of sales variances. A. Flexible budget variance. B. Sales volume variance. Sales volume variance are further broken down into two categories. Number 1. Quantity variance, and number 2. Mix variance. Formula of flexible budget variance. Flexible budget variance is equals to the AP minus SP. The result is then multiplied by the AQ, where AP is equals to the actual price per item sold, SP is equals to the standard price per item sold, AQ is equals to actual quantity of units sold. Formula of the sales volume variance. Sales volume variance is equals to the AQ minus SQ. The result is then multiplied by the SP, where AQ is equals to the actual quantity sold, SQ is equals to the standard quantity to be sold, and SP is equals to the standard price per unit. Formula of the sales quantity variance. Sales quantity variance is equals to the AQ minus SQ. The result is then multiplied by the WASP SM. Formula of the sales mix variance. Sales mix variance is equals to the WASP AM minus of the WASP SM. The result is then multiplied by the AQ. Responsibility center. A responsibility center is any part, segment or subunit of an organization. A segment may be a division, product line, geographical area or any other meaningful unit. Companies will have different segments based on their activities. Responsibility accounting system. A responsibility accounting system is an accounting system that measures the accounting results of each responsibility center separately. The system is also used to combine the various responsibility centers' financial results to enable the measurement of the results for the whole company. Classification of the responsibility center. A. Cost center. A cost center is responsible for only the incurrence of costs. A cost center does not earn any revenue and therefore generates no profit. An equipment maintenance department or an internal accounting department is an example of a cost center. A cost center is the least complex type of center since it has no revenue or the profit. Managers of the cost centers can be evaluated by variance analysis of their incurred costs. The key standard for evaluating a cost center is its efficiency of operations. Efficiency means achieving maximum productivity with minimum effort or the expense. Therefore, the efficiency of operations measures whether or not the center has provided the required services within its budgeted cost. B. Revenue center. A revenue center is the opposite of a cost center in that it is responsible only for the revenues. For example, a sales department is a revenue center. Though every department will incur some costs, the costs incurred by a revenue center are generally immaterial and may not even be controllable by the center. For example, a revenue center's cost may simply be allocated to them by the central company. Managers in revenue centers can be evaluated according to the level of revenue their centers generate. Effectiveness is the key to their evaluation. Effectiveness is the degree to which something is successful in producing a desired result or goal. C. Profit center. A profit center is a department responsible for both the revenues and the expenses. A department within a store, such as the hardware department, is an example of a profit center because it has both the revenues and the cost of goods sold. Because a profit center is responsible for both the costs and the revenues, the manager of a profit center can be evaluated on both the costs and the revenues generated by the profit center. In a profit center, both the efficiency and the effectiveness are assessed, but priority is given to the effectiveness. The profit can be treated as the goal to be achieved. D. Investment center. An investment center is responsible for the profit, revenues and costs and for providing a return on the capital that has been invested in it by the larger organization to which it belongs. Because it is responsible for a return on investment, an investment center is the most like a complete business by itself. However, it is still part of a larger organization. An example of an investment center is a branch office. Effectiveness in achieving and exceeding predetermined criteria is the key evaluation for an investment center manager. In an investment center, the most important criterion for the evaluation is the return on investment provided by the investment center. Considerations when evaluating the manager. When evaluating managers, a company should focus its attention only on those factors that the manager can control. If a manager is evaluated based on something that he or she is unable to control, either a cost or a revenue, the manager may be blamed for or given credit for something for which he or she was not responsible. In other words, the performance evaluation of the manager should be the performance evaluation of only the manager. Transfer pricing. Transfer pricing is most commonly in vertically integrated firms, that is, they are engaged in several different value creating operations for a single product. For example, Division A produces components for a product that is manufactured and sold to the final customer by Division B. Division A and Division B are both the profit or the investment centers. Objectives of the transfer pricing. Any transfer pricing system needs to accomplish the following. It should promote the goal congruence along with a sustained high level of management effort. It should help the company achieve its goals and should fit its organizational structure. It should motivate the profit center managers to pursue their own profit goals while also working towards the success of the entire company. The selling division should be motivated to hold its costs down and the buying division should be motivated to acquire and use the inputs efficiently. It should help the senior managers evaluate the performance of individual subunits and their managers. It should preserve the autonomy in decision making among the managers of divisions if senior management wants a decentralized organization. It should be equitable, permitting each unit of a company to earn a fair profit for the functions it performs. It should meet the legal and the external reporting requirements. It should be easy to apply. Methods of setting the transfer price. The methods of setting the transfer price are market price, cost of production plus the opportunity cost, variable cost, full cost, cost plus, negotiated price, arbitrary pricing, and the dual rate pricing. Formula of the residual income. Residual income is equals to the operating income of a business unit minus by the product of the assets of the business unit multiplied by the required rate of return. Balance scorecard perspectives. The current 4 perspectives of the balance scorecard are as follows. A. Financial. The financial perspective focuses on the organization's financial objectives and enables the tracking of the financial success and the shareholder value. Some of the more common measures of the financial performance are operating income, revenue growth, revenue from the new products, gross margin percentage, cost reductions, residual income, and the return on investment. Financial performance is a priority, but good long-term financial performance will not be achieved if the goals in the other non-financial categories are not attained. B. Customer. The customer perspective involves identifying the market segment or segments the company wants to target and then measuring its success in those segments. A common method of measuring this success is the trend in the company's share of the market over time and the degree to which its market share increases in line with the management goals. Customer satisfaction is another vital part of the customer perspective because if customers are not satisfied, they will take their business elsewhere. Customer satisfaction goals relate to how the company's management wants the company to be viewed by its customers. Management may want to become the lowest cost supplier, in which case pricing goals will be part of the customer perspective. C. Internal process. The internal process perspective includes the innovations and improvements in products and services, operations, and customer service needed to create value for customers, which in turn furthers the financial perspective. D. Learning and growth. The learning and growth perspective originally focused on employee learning, but it now covers not only the human capital but also the organizational capital and information capital. Initially, innovation was part of this perspective, but users of the balanced scorecard system concluded that innovation properly belonged in the internal process category. The learning and growth perspective includes the capabilities that the organization must have to achieve its objectives in the internal process perspective. Currently, the components of the learning and the growth perspective include human capital or the skills, talents, and knowledge of the employees, information capital or the information systems, networks, and technology infrastructure of the company, and the organizational capital or the company's culture, leadership, degree of teamwork, and knowledge management. Key performance indicators. The business needs to select only a few critical metrics that are most relevant to its specific business strategy and then track these measures rigorously rather than using many different measurements. These critical measures are called the key performance indicators or the KPIs. The key performance indicators are measures of the aspects of the company's performance that are essential to its competitive advantage and therefore its success. Strategy map linking with the 4 perspectives of the balanced scorecard. A strategy map links the 4 balanced scorecard perspectives together, beginning with learning and growth. The goals of the learning and growth perspective contribute to the internal process perspective because the company's culture of empowering staff members and providing them with the technological support they need makes the innovation and improvements in products and services possible. The innovation and improvements in the products and services in the internal process perspective supports the goal of the customer perspective, such as increasing the market share. Increased market share from the customer perspective leads to the increased profits, thereby supporting the goals of the financial perspective. Benefits of this balanced scorecard for performance measurement. The balanced scorecard encourages managers to focus on elements that tend to lead to long-term success instead of on short-term financial performance by rewarding them for improvements in those elements that tend to lead to long-term success. Evaluating and rewarding managers based on these non-financial indicators should lead to the long-term financial performance improvements if the proper non-financial indicators have been selected. Limitations of using a balanced scorecard. It is difficult to use the scorecards for comparison across the business units because each business unit has its individual scorecard. Scorecard evaluation is more effective when it is used to judge the progress of an individual business unit relative to the prior year or relative to its goals, rather than when used to compare a manager's performance with that of other managers or a segment's performance with that of other segments. To successfully implement the balanced scorecard performance measurement, a firm must have the extensive enterprise resource planning systems to capture the required information. Non-financial data are not subject to control or audit, and thus the data's reliability could be questionable. The efficacy of the balanced scorecard in achieving the organization's strategic goals must be monitored closely. If all the non-financial targets are achieved, but the financial targets are not achieved, then probably a strong causal relationship does not exist between the non-financial indicators chosen for monitoring and the financial goals. The non-financial indicators may need to be re-evaluated and changed. If the balanced scorecard is used as a command and control document that is used to control the behavior, employees may make the numbers but not be committed to achieving the organization goals. Instead, the balanced scorecard should be used to create an environment in which everyone can learn and grow. Difference between the avoidable and the unavoidable cost. An avoidable cost is a cost that can be avoided if a particular option is selected. An unavoidable cost is an expenditure that will not be avoided. In other words, will not go away regardless of which course of action is taken. Avoidable and unavoidable cost needs to be identified in deciding to drop a customer or discontinue a product. If dropping the customer or the product would avoid the certain costs, the avoidable costs are relevant to the decision. Unavoidable costs, however, are irrelevant because they do not differ between the two alternatives. This learning video is designed from my book CMA Part 1 Financial Planning, Performance and Analytics 2022, which is available for subscription from my website zenacademy.us or the mzen.org. Please do like the video, share it and subscribe the channel for amazing contents. Feel free to ask any questions relating to studies through WhatsApp on 923112224261 or through email at help@zenacademy.us or help@mzen.org. May Allah, Lord of the heavens and the earth, bless you in this world and in particular in life hereafter. Ameen. Have a nice day with love and care. Allah Hafiz.